important topic. There we go. Okay. So the recording's in progress. I've already had some people ask if we're recording it. So as soon as it's done, I'm sure Walt's going to forward it to us. Kelly, pop up here and say hi. This is my sales manager.
Good morning.
She's always on the call, but you guys get to see her in person today. So we have a golf tournament this afternoon. So that's ready for in 85-degree weather. So I'm going to let you take it from here. Are you ready?
Perfect. Let's go.
All right. Thanks, Walt.
So you guys may have heard of the beautiful changes that are occurring here in the mortgage industry. So I wanted to talk to you. Actually, I was talking to Tracy about this week. We were talking about the class that we are doing in a couple of weeks from now, and what we could bring to the market and what would be beneficial, and started walking through the changes of the LLPAs. And she then calls me back just a few minutes later and said, "Hey, can we do a class on that like now?" So there's a lot of changes coming, and I'm going to tell you that there's a ton of misconception. And when there's misconception, that's when I have a tendency to want to really step up and lead from that point, because it drives me absolutely batty what the media is saying, and then it drives me even more batty, crazy, whatever you want to call it, when I see loan officers in our industry, local and national, kind of sweep this under the rug. And basically there's, the idea is there's nothing to see here. Just keep moving. There's nothing to see there, just keep moving. So what I wanted to do was talk to you about loan level pricing adjustments today, talk to you about pricing, talk to you about what has already happened, because this has already happened. So it's old news in the sense that it's already happened, but how can we combat that? The reality is I'm going to tell you that mortgage rates have now become a game, and I don't mean that in any weird or bad way. It's like credit scores. Credit scores, there's a game that you have to play to get the best possible score. There's things that you need to do to be able to do that. Well, now with mortgage rates, it's like going back to a game. And it's more important than ever to work with somebody who's a mortgage strategist that's not just going to put somebody into a loan, but will really look at the loan and see what they can do to be able to secure the best rate and the best terms, and to be able to help the outcome of the individual. So, and again, there's a lot of loan officers out there that are just going to stick people in loans, but it's so important, more important than ever, to work with a mortgage advisor or mortgage strategist. So let me walk through what we're looking at here. Share the screen. Okay. So first off, and this is something that earlier in the week I had missed and actually had forgotten, is that these loan level pricing adjustments all came into play, or they're coming into play for loans that are sold after May 1st. Now, when a loan is sold after May 1st, that means that we've had to put these loan level pricing adjustments into play about 30 to 45 days ago. In my research, I found that the letter came out in January, and in January is when a lot of lenders started changing their fee structure at that point. And I'll explain what that means in a minute. So they started doing that. We changed ours about 45 days ago to be able to reflect these new loan level pricing adjustments. Now, let me walk through really the media. The media is making this out to be a really, really bad thing, that the sky is falling. And of course, the media sells airtime, right? So that's not news to you guys, and I talk about this all the time. So there's an article in the Washington Times: Biden to hike payments for good credit home buyers to subsidize high-risk mortgages. Is that true? Well, part of it's true, but part of it's not true. The other one here, this one that was on Fox News, So Fox News, 620 FICO score gets a 1.75% fee discount. 740 FICO score pays 1% fee. Is that true? Well, it's partially true. And we'll dispel that in a minute. Biden rule will redistribute high-risk loan costs to home buyers with good credit. So saw somebody had their hand up. Okay, I'm going to disregard that. So is that true? And then the last one here, the New York Post, how the U.S. is subsidizing high-risk home buyers at the cost of those with good credit. Again, partially true, partially not true. We'll talk about it. Again, there's a way to be able to, I'm going to say that's probably the most true one here. It doesn't sound good in any way, but it's probably the most true, but there's a little twist on it. So first off, what are LLPAs, or loan level pricing adjustments? They're basically just risk-based pricing. They are fees charged to the borrower, and they're going to be based upon down payment, property type, debt to income ratio, type of mortgage. They are not fees that the investor or that we as the lender put on, or banks put on. It's anytime we sell a loan to Fannie Mae, there's going to be loan level pricing adjustments that are going to be incurred there, and it's based upon risk. Now, let me state that these do not include jumbo loans, FHA loans, VA loans, or USDA loans. These are only on conventional loans. Now, FHA came out earlier this year to combat a little bit of these loan level price adjustments that conventional were changing. And FHA lowered their monthly mortgage insurance. Remember that on FHA, you have an upfront mortgage insurance that's financed on top of the loan amount, but then you have a monthly mortgage insurance. It was at 0.85, it's now at 0.50. That helps more individuals be able to qualify for a little more home. It lowers the price of the monthly price of the monthly mortgage insurance. So that's a really good thing. These loan level price adjustments are basically just risk-based pricing. And again, I'll walk you through these, but it's risk-based pricing. And the lower the risk, the higher the credit score, the lower the risk, you're going to have lower fees than if you have a worse credit score, a lower credit score, you have higher risks, so you have higher fees. So that's really the way in which those work. Now, one thing that I wanted to show you here is we get calls all the time, and this is directly from our website, which you can search. If you just search Walt Schultz Canopy Mortgage, you can see my Canopy Mortgage website. And then if you hit today's rates, this is the screen that pops up. We're very transparent in our rates. Now, I get called all the time saying, hey, Walt, what's your interest rate? And realtors all the time ask me, what are the rates? And that's part of our job, right? Well, if I've ever answered that question for you, then it is, or to you, it is, I always give you a range because there is not one rate. So in here, I put in a loan amount of 500,000, a purchase price of 500,000, 5% down, 780 score, and a conventional 30-year fixed. I put in all the information that we needed to. And when you open up the rates, I will tell you that today's rates are from 4.99% all the way to 7.625%. So what rate do you want? Well, of course, I want the 4.99%, right? Okay, if you want the 4.99%, it's going to cost you $27,000 to buy that rate down. The reality is that doesn't make sense. That just flat out does not make sense. So you start to come down the fee of what the cost is on the rate until there's about a 1 point fee. And you'll notice here at 6.5% right now today, literally right this minute, the fee is 1.088%. in order to get a rate of 6.5%. Now, with this market, I'm not a big believer on, if we can avoid those fees, the better. But it's going to be what's suitable for the client and what we need to help the client do. Today I'm going to talk about fees, and I'm going to talk about rates as we talk about loan level pricing adjustments. So you'll notice here as we start to come down, the 6.625 is about $1,000, $1,200 cheaper. And then it bumps up. The 6.75 is almost equal to the 6.5 rate. Well, that's because the bond coupon at an 8 is trading a little better than maybe at the quarters. So here we've got 6.875. We're now down to $5,000 in fee, 6.99 down to $3,400 in fee, 7.125. We're down lower, all the way to 7.5. We're at 7.5. We will actually pay you 0.43% or $2,042 to secure that rate for you. When we sell the loan to Fannie Mae and Freddie Mac, they're going to pay us an extra $2,042. We then push that on to the client. Now, with that said, when I say that it's more important to work with a mortgage advisor, a mortgage strategist than ever, that is exactly the reason. It's important to know how long this client's going to be keeping the money and how long is this loan going to be in play. Now, we realize that in today's market, in a highly inflationary market, most loans today are going to refinance in the next year to year and a half. As soon as inflation starts to tick down, which it's ticking down, so as soon as it continues to tick down, interest rates will get better. We're anticipating rates to be somewhere in the fives, in the solid fives, by the third quarter of this year, worst case by the fourth quarter of this year. Possibly we can hit the fours by the fourth quarter of this year or the first quarter of next year. So it becomes who of us to know, okay, how long is that client going to need this loan? Are they going to refinance in the next year to year and a half, 2 years? Do they need a lower rate to qualify? Because at that point, we may need to have a little bit higher fee. So getting that lower rate, remember at 6.5, there was a 1 point fee. So if it's a $500,000 loan, it's $5,000. At 7.5, we were paying $2,000 to that client. So do they need help with closing costs? That's a way that we can help with closing costs. So that rate becomes really a sliding scale. So there is no one rate for any lender. It is a myriad of rates. There is a rate stack. Now, as we understand that, we then start to go back to the loan level pricing adjustments. And as we look at the loan level pricing adjustments, there are 30 factors or 30 loan level pricing adjustments for every loan. This is where I always talk to a client and I tell them that interest rates are like fingerprints. We all have a variation of the same fingerprint, but we don't have the same. No two people have the same fingerprint, but we all again have a variation of the same fingerprint. So the loan level price adjustments are going to be based upon loan amount. A lower loan amount, $50,000 loan amount, for instance, is going to have a higher loan level price adjustment than a $400,000 loan amount. A loan term, so is it a 7 or is it a 30-year term, a 15-year term, 20-year term? How long is the term? Purchase or refinance? What's the loan to value? What property and state? I will tell you that in the Pacific Northwest, I know that we have a little higher rates than East Coast clients do, or even Midwest clients do. We pay a little bit of a premium here. I honestly don't know why, but I do know that's the case. And I also know that California clients have the most premium. So their loans are actually priced a little bit higher. Again, for whatever reason, I don't know why. Maybe it's because they live in sunshine all the time. I don't know. But why we pay a little bit higher rate for living in rain most of the time, I don't know. Maybe it's the green. Anyway, property type, occupancy, credit history, asset verification. How are we verifying your assets? relocation, concessions, employment status, co-borrower. Do you have an occupant or a non-occupant co-borrower? What's the lock period? 7, 15, 30, 45? Do you have to lock for 360 days? So what's the lock period? The longer the lock period, the higher that loan level pricing adjustment. Hence, you have one of two options. These loan level price adjustments that I'm talking about, you can either pay in a higher interest rate, or you can pay in a higher fee. So let's just, well, I'll cover that here in a minute. So underwriting, is it DU or LP? That means, are we selling it to Fannie Mae or Freddie Mac? Sometimes Freddie Mac will have a little bit better rate than Fannie Mae on certain products. Loan type, amortization. Is it a cash out refinance? What's the amount of the cash out? What's the combined loan to value? Is there a combined loan to value? So for instance, we have 101% financing. That 101%, you're going to pay a premium because it's 101%. You have a 97% first, and then you have that 4% second. So the combined loan to value is a little higher risk, over 100%. What's the property counting? Number of units. Is it a 1 unit, 2, 3, 4 unit property? What's the credit score? Debt to income ratios? Do you have reserves after we close? Are there gift funds involved? What's the income verification? Employment docs, citizenship, mortgage insurance. This is a big one, and we've talked about this a ton in the past. But with mortgage insurance, is it monthly mortgage insurance? Is it a single premium mortgage insurance? Or is it lender paid mortgage insurance? Lender paid mortgage insurance, you're going to pay a little bit higher loan level price adjustment, which means a little bit higher rate than to be able to cover that. Escrows. We've got Fidelity that's sponsoring the call today. Thank you, Fidelity. You guys are awesome. Love you guys. This is not Fidelity. This doesn't matter what title company you go to. This is whether the client has an escrow account or not, meaning are they paying their monthly payment with their taxes and insurance or not? So is there an escrow account or not to pay the taxes and insurance? These are the 30 loan level pricing adjustments that we currently have. Now, when we look at the changes, these changes come into effect May 1st. Let me reiterate though, they come into effect May 1st for all loans that Fannie Mae is purchasing after May 1st, which again means this pricing model has already come into play. So your clients have already felt it. And this pricing model is not something that I really believe in. I think that it can hurt some clients. I think it will definitely benefit some clients. I think that sometimes when Congress or others get involved in the loan process, this isn't all the time, and I don't want to get political here in any way, shape, or form. But I see that, as Congress has gotten involved in appraisals, I see that appraisal costs have gone up significantly. I remember I've been in the business now 25 years, and so appraisal costs used to be $350, $400, and now we're at $1,000 for an appraisal. And so I know when TRID hit, a company that I worked for at that time, which was a top 10 lender in the nation, top 10, top 20 lender in the nation, we had to add 100 new employees and add 4 new divisions to our company just to track all of the TRID information and compliance that was happening from TRID. So I think Congress they want to help, and the people want to help, and that was the whole point of bringing this forth, is that they wanted to help people with lesser credit qualify for more home or help with their payment. We have an affordability issue in America right now. That's really what we have. Of course, we have an inventory problem. We have some other issues, but at the end of the day, people are now starting to get priced out of mortgages. So with that said, you're not getting political or anything. I think that with this, I think that the powers that be tried to create an environment where they could help more people qualify and afford more home at a little bit lower rate. Now you'll notice that in these loan level price adjustments that there are some additional hits here in the middle that we didn't have. And so those are the higher loan level price adjustments that clients are going to pay. And then over here, you'll notice that 3% and 5% down, everybody, it didn't matter what credit score you had. Over here on the right are the credit scores, up here on the top are the loan to values. And so it doesn't matter what credit score you have, everybody improved with a 3 and 5% down. I want to make sure that you got that because this is going to be key to what I'm talking about here in a little bit. Everybody got a better interest rate, everyone, if you're putting 3 or 5% down. The problem that I see is, and this is again where working with a mortgage advisor is going to be so important, and a mortgage strategist is so important, that, and if your lender's not talking about this, this is the mistake that I think most lenders are making. These hits right here, for instance, let's take a $100,000 loan. For a $100,000 loan, if you're at a 780 credit score and you're putting 5% down, you're now getting an additional $625. For a 639 loan, 630 loan, you're now getting an additional $1,750. So you're getting that to be able to lower the rate in essence. And I'm going to bring that down a little bit more. So I'm trying to bring you guys behind the curtain and teach you how pricing works, which took me some time when I first got in the industry. Now, what I don't like about this model is that with this model, the people in the middle, the 740 credit scores, I'll be honest, I don't have a client that comes in with a 780 credit score very often. I mean, we just don't have it. Kind of like a cash buyer. It's like, man, when you get a 780, it's like, woo, this is going to be cake. But for those clients that are coming in, most of my clients are 760, 770, 740, 720. So they're going to be in this area. You'll see that the hardest hit are going to be the 720 to 759 credit scores, putting 15 to 19.99% down, almost 20% down. Now, as you look at this, you'll see that everybody, if you put 30% down, ends up with no loan level pricing adjustments at this level. And then you'll see that if you put 30% down, you actually get a little bit better rate here if you have a little lower score. Again, we don't have many clients that are putting 30% down. But here, this area, so if we have a client coming in that's putting 10, 15, 20% down, even 25% down, I'm going to counsel them a little different way from now on. And this, I believe, is truly the biggest mistake that lenders are bringing to it. I think that the media is concentrating on the fact that, yes, this hurts good credit borrowers. It's going to hurt them a little bit. But I think it also helps a lot of people. But if you're a good credit borrower, if you put less money down, then this will actually benefit you. So I think it can benefit everybody. So let's look at the old loan level pricing adjustments prior to May 2021. You'll notice that the credit scores went to 740. And you can look these up on FannieMaeLLPA.com or just Google search Fannie Mae LLPA. So you'll notice that credit scores went to 740. 740 was the best possible score or higher. If you had a 740 or higher score, then you had the best rate. Well, now we have a 760 tier and a 780 tier. So we've gone up there. Again, you'll notice that the loan level price adjustments here at prior to 2020, prior to May 1st, are right here, a little bit higher. And then you'll see that they've gone down. Pay attention to the 620 here, 620 to 630. You were paying 1.75% before. And again, now you're paying, it's actually this level here. You got to pay attention to these 620. You were paying before a 3.5% fee to get to that level. We're now to 1.75% fee. So you're saving 1.75%. So, so again, as we're coming back to these are already in play. Now it just means, what do we do? And how do they affect your client? So let's start to walk through what your client can expect and really how to explain these. Now, again, I don't think I have this. I think I actually shut this down here. Nope, I still have it up. Okay, perfect. So let me share my screen again. Okay. So the question is, does this affect your client's interest rate? And that answer is, it depends. Because again, as I'll start to show here, it can affect the interest rate or it can affect the fee. So I'm going to start talking about fee and interest rate. It's important that you guys have that down. So fee and interest rate. And I'll answer everybody's questions here at the end. So what does it affect? Now, as we walk through here, as I'm showing you the rate stack for the 780 credit score with 5% down, let's say that the client, again, that the client doesn't have the money for the fee. Well, then we just increase the interest rate to be able to cover. So a client comes in, and again, this is mortgage advisor advice. Client comes in and they need $28,000 to close between down payment and closing costs, but they only have $23,000 or they have $25,000. They don't have $28,000, but they need that. Well, they're getting a paycheck coming up, so we know that will cover some of it. Well, at that point, we then know that we need to contribute. So they may have a higher rate. We may go up to the rate of 7.625, 7.5, 7.375 to then cover some of those fees. So all of these changes that are occurring either will be to the fee or to the rate. And if I have lost you, I apologize. And I'm happy to talk to you one-on-one. So to the fee or the rate. And I think this will help illustrate what we're looking at. So a 760 credit score, this will hurt the 760 credit score a little bit. Where that 760 credit score, in order to get the same rate, 6.625, they can either increase the rate to 6.875, or, and this was pricing a few days ago, or they can pay $1,000 fee to get that 6.625. So that's how it works. I'm just going to say, from now on, I'm going to say this is prior to May 1st, which again, this pricing really went into effect about 45 days ago for most lenders. A bunch of lenders actually priced this back in January. So, but again, I'm kind of covering this a lot. So I want to make sure that I really drill this in. 760 credit score prior to May 1st, interest rate could have been 6.625. The same structure now, your rate would be 6.875, or you can pay $1,000 fee to buy that rate down to 6.625. An additional, did I say 5,000? An additional $1,000 fee. So one or the other, which one do you want? Now, if you take the higher rate, that then takes your purchase price from 500 down to 488 at the same payment levels. So it decreases the amount that you can borrow at that point. Now, how do you pay for that $1,000 fee? You guys will love that the seller can pay it. So you guys don't already negotiate enough, do you? So, and I'm joking on that, but you know, the seller can pay it, but the reality is the market that we're really heading back into, the seller's not going to pay it. So client can pay it, you know, they can get a gift for it, whatever. Now, this is where I'm going to talk about the game. Client comes in prior to May 1st, rate would have been at a 740 credit score with 15% down. Rate would have been 7%. And this was pricing earlier this week. Market's gotten better since. So client would have gotten a 740 credit. I'm sorry, client has a 740 credit score, 15% down. Client would have had a 7% rate. After May 1st, rate jumps to 7.5. So pretty significantly. If that client needs that same payment and only qualifies for a $2,827 payment, and I'm looking at only principal and interest on these guys, I'm not looking at mortgage insurance, I'm not looking at any of those other factors. This is just principal and interest. I want to get this as apples to apples. Each case is going to be different. So, but I want to get apples to apples, just principal and interest. So, client after May 1st, payment jumps up. Instead of that, so the client decides, okay, I'm gonna do I'm gonna keep the rate of 7.5%. Buying power goes down $25,000. So it hurts the client, right? Hurts the client. The client can pay a $3,187 fee to buy the rate down. Again, where do they get that money from? So they could do that. Now you'll notice that just the down payment and then the fee to close, not all the additional closing costs, but the down payment, the fee to close goes from $80,000 to $75,000. So, or basically $76,000. So they have the money to pay that additional fee to buy that rate down. Again, getting them back up to the $500,000 purchase price. But then that's gonna increase some of these fees here. So here's the thing. Here's where being a mortgage advisor, mortgage strategist, again, is more important than ever. What if we did 5% down? Because remember, everybody at 5%, 3% down gets a better rate. What if we did 5% down? So we took the 740, instead of 15% down, went to 5% down. And if they qualified for a $500,000 loan, instead of putting 15% down, they put 5% down. This is where it starts to get fun. They take that $5,000, and have you ever wanted to work with a financial planner? Here's your chance to do so. They take that $50,000, and with the help of a financial planner, they then invest that into a financial plan, and literally $50,000 over 21.92 years at a 7% rate. And you'll say, where do you get a 7% rate? You get it all over the place. And it's 22 years. So it's an average at a 7% rate. You'll have enough money in your account to physically write a check and pay your mortgage off. This is the mistake. People are not covering this. So as you take that investment, I mean, that sheds, honestly, that sheds so much money from that client. Now, if that client keeps that for 30 years, I mean, think of that. If that client kept the money for 30 years. So instead of me going into my software and do this, I'm just gonna do it on my calculator. So it's 7% over 30 years, $50,000 payment one time. Remember that compound interest loves time. So $50,000 over 30 years. That grows, if they chose not to pay their mortgage off, it grows to $405,000. So this is why I'm calling it the $400,000 mistake, because nobody's covering this. Nobody. We have an affordability issue in the US right now. And so, and this will help clients become a little more affordable. I'm going to show you again here down some others, 707 and a 630 score. So clients can, they can potentially get more affordable, but the clients that instead of putting so much money down, put less money down, get the better rate that helps it be a little more affordable. Let's do the math and figure out what makes sense. Work with a financial planner, which you've always wanted to do. Realtors have never worked with financial planners historically because what do you do? How do you work with them? You don't know. And so from there, then you work with the financial planner, invest that money with the financial planner. The financial planner loves you now. Your client loves you. And that money grows to over $400,000 over 30 years, or we can pay the house off in 22 years instead of 30 years, saving the client oodles and noodles of interest over the other 8-year period. That's why I'm calling it the $400,000 mistake. Let's get away from the negative on this, which the media has already brought enough negativity. So let's get away from that and let's start to work this in a way that helps our clients the most. Now, as we look here, 7% or 700 score, 5% down, this is where it starts to help people. So a 7.125 rate you would have had prior to May 1st, the rate now goes down to 6.875. So it's a little bit lower rate. And also your buying power goes from 500 up to 512. So, so your buying power goes up that way. A 630 score, you would have had a 7.625 rate. You're now down to around 6.5%. And with that, again, this actually you're getting about an $8,700 benefit from the loan level pricing adjustments, and there your buying power goes from 500 to 560. So helping people to be able to do that. And again, this is the real fun, guys. For me, one thing that really hit me was during COVID, I started looking at our clients. And one thing that really concerned me was the amount of retirement savings that most of our clients have. And in my studies of that, I then realized that 78% of Americans lose sleep over retirement. Those that are 50 to 60-year-olds have a tremendous amount of money in their home, in their equity, especially over the last couple of years, but they haven't saved up a lot for retirement. So they don't have a lot of retirement savings. In fact, in talking to my team, and we were just reflecting back on all the clients we've helped over the years, we were reflecting back on the clients that had $200,000 in retirement savings, which we couldn't remember hardly any. And then we remembered a few that had $100,000 in retirement savings, but the majority of our clients didn't have that much. They may have $40,000, $50,000, $60,000. I'm going to tell you that clients that are working for the state that have PERS, if you're on PERS level 3, those clients are really nervous. So they're wanting to build for retirement. So this is a way to be able to help those clients build for retirement and that's again really on our side to help. So here is a 630 score, 5% down. Again, you would have had a 7.625 rate. Your rate now is going to be lower in the 6.5 range level. And with that, your payment savings is going to be around 3.5 or 3.5, $359 a month, $360 a month. So if you take that $360 a month and you keep the payment at the same level as what you would have had prior to this, you've got two choices. You do that, you then are actually going to, and you keep the purchase price the same level, 500,000 instead of going to 560. You then will actually be able to pay off your mortgage in 22.42 years. Again, saving a tremendous amount of equity, or I'm sorry, interest on the loan. So instead of a 30-year mortgage, now it's a 22 and a half year mortgage. And then again, here's the fun. If you invest that with a financial planner, the $360 a month over 30 years at a 7% return, that money grows to $438,000. So imagine, for me, I'm going to tell you that that legacy is important for me. And so what is legacy? Legacy is a lot of things to a lot of people. For most people, legacy is when you've passed away. And so what's your name known for when you passed away? For me, legacy, I want to see my legacy. I want to know the impact that I've had upon others and the impact that I've had upon clients and that. And so for me, I'm trying to leave a legacy today. That's one thing that we started, or we took over the Shop with a Cop program here in our area. And we've grown it to the largest Shop with a Cop program in the nation. Last year, we helped over 700 kids get a Christmas present with a police officer. So we're trying to bridge those two gaps. A lot of these kids, they may not even get a Christmas present during Christmas. And some of them have recently had their parents taken away by the officers. And so for different reasons. And so there, I mean, it's a tough world for people. So so when I had the opportunity several years ago, Jason Myers, the sheriff at the time, and Troy Clausen, the undersheriff, came to me and said, "Hey, we're starting a charity, Believe in Your Community, and we want you to be involved in it. We want you to be the president of it." I jumped at the chance. I mean, you know, to be able to bless the lives of others and to be able to help them. So, and again, we've grown that to the largest Shop with a Cop program in the nation. This year, we're actually kicking off a Shop with a Cop back to school. We're doing that here in August, where kids will be able to shop. It's a lot less kids, about 100 kids or so. They'll be able to shop for clothes for school. So about 100 kids that will be able to do that. So, so we're growing that program. Point being, legacy to me is everything. Legacy is what I do today, how I help others, the impact that I've made upon others. And I want to see that legacy. And so through that, the whole loan level price adjustment thing, as I see the media getting it wrong, they're making it more negative than it really is. We can make it negative, but let's look at the positive. Let's really take it to the positive. Let's restructure financing for people, helping them to be able to invest for their future. So now they get their house and they get the money they need for retirement. Let's help in a holistic approach instead of just getting them into a house. And again, I hope that through this, that you see the lenders right now, they're kind of sweeping this under the rug. That are saying, you know, and I got a text just the other day from somebody seeing something on Facebook of a lender that was kind of sweeping this under the rug, saying nothing to see here, you know. Well, there is something to see here, and there is good news that can come from this. It's helping people that couldn't qualify for a home qualify for more home. It's helping to be able to get clients into a conventional loan where historically they've gone into an FHA loan. FHA has mortgage insurance the whole life of the loan. So, you know, so plus it has that funding fee, you know, and if you're at a, let's just say a $400,000 purchase price on FHA, that funding fee is $7,000. So it costs them $7,000 just for the right to use FHA. That gets financed on top of the loan amount. So again, these fees can be either increased to the rate. You can increase the rate, or you can pay the fee to buy the rate down. So it's one or the other. You don't have to have it. This doesn't mean it has to create higher interest rates, but it does mean that you're either going to, for some people, you're either going to pay a little bit higher fee, and those are unfortunately people that put a little more money down, that have a little higher credit scores. You're going to pay a little higher fee or a little higher rate, or for those people with lower credit scores, it means that they're actually going to get a little more buying power. It's going to make homes a little more affordable than what they have been. And then again, what do you do with that? Do you take the better rate, qualify for more home? Do you take the same rate or the same purchasing power? And at that point, then instead of qualifying for more home, maybe you invest the rest. So what does it mean? So I hope that this really answered your guys' questions. Pricing is difficult, and it's difficult to explain. I did a video on this not too long ago. I shot 2 different videos, and each one was about 15 minutes, and I kept trying to get it shorter. And it's just not something that you can really go through in a quick fashion. Even this class, I was trying to make this class be about 30 minutes or so. So there was a lot of time for question and answers. And here we are, 45 minutes. So I appreciate you guys. We are here as a Schultz team to be able to help your clients. Send us your next client and let us walk through with you what we can do, how we can do it, how we can structure the loan. We'd be honored to be able to work with your next client. So you go to the questions and answers. What about comparing the par rate? So Angela, and that is a par rate is basically a 0 fee rate. So yeah, so I mean, looking at a zero fee rate you can do. So do all borrowers have to pay mortgage insurance if they put 5% down? Yes. Mortgage insurance hasn't changed. They're still going to do that. Hope you're sending us the slides. Yep, I can send them to you. Is the buy down for life of the loan? Yes, it is. And then Shop with a Cop is amazing. Thank you very much. Yeah, we love volunteers. So borrowers able to put 30% down or more, avoid higher LLPAs, and that is for some, yes. And it used to be you had to put 40% down to be able to get the best possible rate, and it's now about 30% down. So again, I mean, there's some positives in here. So another realtor asked if I heard about a 40-year mortgage. Oh yeah, Grant, the 40-year mortgage. I love that one.
I don't
So
see Bruce Frederickson in here, but oh, whoops. Sorry, I didn't realize I wasn't unmuted. Sorry. Trying to get everyone's CDs set up.
So the 40-year mortgage is a myth right now, and the 40-year mortgage might come, but really what it was a bunch of people starting to come forth and announce a 40-year mortgage for FHA, which was not a thing. The 40-year mortgage actually ended up it was a loan modification. So FHA will do a 40-year mortgage based upon a loan modification. You have to work directly with HUD on that. But there are no 40-year mortgages. So there were a lot of people that jumped on that bandwagon talking about the 40-year mortgage coming. It's a myth. Doesn't come into play. So Mitch, there's multiple different financial planners that I endorse on that. And so it depends upon really what you're looking at. So I'd be happy to talk with you one-on-one about that. So again, if you guys have any questions, please just reach out to me. Happy to help in any way. Lenders using a FICO score when a couple of those applying for a loan. Is there still a case? So we don't use the lowest FICO score. So, well, let me rephrase that, Amy. So great question. If a couple are applying for a mortgage, we use the middle FICO score of that couple. However, out of that couple, let's just say, because Tracy is right here in my picture. So Tracy and I are married. We apply for a mortgage. My FICO score is 580. Tracy is very responsible. She has an 800. And that's her middle FICO, and that's my middle FICO score. We'll use the lower of the two FICOs, so we'll use my FICO score. Now, when you're talking FICO score, I will say that's a whole different conversation about FICO and credit and how you can get a higher score. I've got a class on that, happy to share with you guys. But there are 9 FICO scoring models now, and lending is the one that uses between 5, 6, 7 of those to be able to get the FICO score. So, and again, I can explain whoever wishes on a later date. So across the board, including second homes. Yeah, so Tiffany well, there are new loan level price adjustments on second homes and investment properties. Those came out earlier this year. So you guys can always, again, just go to my website, just Google search Walt Schultz Canopy Mortgage, go to that site. You guys can just type in your scenario, whatever scenario you're looking at. And at that point, it will walk through what the loan level price adjustments are for that loan and what the rates are. So you can always see the rates right there. So, all right, guys, I hope that answered all your questions. Thank you. Thank you for the time. And I hope this made an
Thank you,
impact.
Walt. It was awesome information that I really appreciate you throwing this together in like 3 days. So it's awesome. And we had like 87 people on the call. So I hope everybody got some great information. And if you want more help, reach out to your favorite sales executive at Fidelity. And have an awesome weekend. Go enjoy the sun.
Go enjoy the sun. See you guys.
Bye.